So welcome everyone and give us an idea of what's in store for this afternoon. I would like to introduce here on stage the President and CEO of Sewell Financial Group Inc. Let's give a hand for Mr. Dino Bate.
Okay, good afternoon to everyone. I'd like to welcome CL customers, fellow investors, and guests to today's event entitled Picking the Right Investment with CL Financial or CL Fund Source. I know that this is very timely, especially for those of our customers who've been trading this market for the past even month or even less than that. And we've seen market volatility has really risen. And we're very fortunate today to have a lot of industry experts with us. And of course, our very own April Tan, who will also discuss her market perspectives given this market condition. I know that if you are not mentally prepared in this market and you see this kind of volatility, sometimes you will have to react emotionally or sometimes hastily. And I hope after this session, you will now have a clear understanding of the conditions or market conditions today. We're also very fortunate today that we have with us who will also be speaking one of the industry's investment managers or top investment managers in the industry, Marvin Fausto, who is COL's fund expert. He will talk to you about mutual funds, which is something that we are now introducing in our website. And we believe that this is a strategic investment for you guys to consider as it gives you a chance to diversify your portfolios to even different asset classes or even into equities. And this will also help you manage your risk. I'd like to reiterate to everybody that CL Fund Source has been created just like what we've done for stocks. We made investing in mutual funds easier and simpler for everyone. We have the top 5 mutual fund houses with their different funds available in our site in a single platform. We also made available online tools and, of course, research or resources for you to be able to use to be able to make the smart choice for the investment best suited for your investment, your financial goals. I'd like to also tell you that, again, remind you about our commitment to our customers, that we would really want to be part of your investment journey as you build your wealth and become what we call have a richer life. So before I turn you over to the next speaker or to the main event, I'd like to thank our fund sponsors who are here today, namely ATR Asset Management, Philam Asset Management, Phil Equity Management Inc., Sun Life Asset Management, and First Metro Investment Management. I encourage you to go to their booths during the breaks or even after the whole session to inquire more about their products and services. So I'd like to again welcome everybody to this event, and I hope you come home with new learnings and hopefully have a very clear approach to building your wealth. Thank you and have a good day.
Thank you, Mr. Dino Bate. Now let's start our program. To give us an outlook about the stock market today, let's give a hand to our first speaker, the Vice President and Head of Research of Sewell Financial, Ms. April Lynn Tan.
Good afternoon, everyone, and thank you for attending our seminar this afternoon. Okay, picking the right investments with UL Fund Source. So this afternoon, I'll be talking about our outlook for the stock market. Okay. So I guess, being an investor myself, I think one of the most important questions everybody has today is whether or not, what we're seeing today is actually the start of the bear market, or is it just a major correction? And to be able to answer that question, I studied actually the past few bear markets and past few corrections. So before I start, I'd like to share with you this quote from Paul Samuelson, who is a Nobel Prize winner, who's an economist. And he said that Wall Street indices have predicted 9 out of the last 5 recessions. And the way I see it, what we're seeing today is 1 out of the 4 false alarms and not 1 of the 5. Okay, so the PSEI is actually now down by 1.7% after rising by more than 12% earlier this year. So I guess everybody's wondering, given the very good start that we had, what has changed? Why has the market weakened? Okay, there are many reasons for the pullback. Of course, what's really fresh in our minds right now is what's going on in China. Okay, right now there are concerns regarding the devaluation of the Chinese yuan, and of course, concerns about the slowing Chinese economy. But it doesn't help also that we're seeing contagion from the sell-off of other Asian markets. I mean, typically, fund managers will view the Philippine market together with other Asian markets such as Thailand and Indonesia. And as you can see from the chart that we have provided, we are down 1.7%, but the red line, which represents Thailand, is down 6.8%, and Indonesia is even weaker, down by 14%. So typically, when foreign fund managers buy markets globally, they consider Philippines, Thailand, and Indonesia in the same basket. So they can't just sell Thailand and Indonesia. They also have to sell Philippines. Then finally, we don't have catalyst locally, although we are one of the fastest growing economies in the world. Our earnings growth or corporate earnings growth and GDP growth were a little bit below what people expected. So if that is the case, then it would be difficult to justify the Philippine stock market performing much stronger than all our other neighbors. Okay, but our first conclusion based on the study that we've done is that what we're seeing today is just a major correction and not a bear market. And the reason why we are saying that, why we're saying we're not expecting a bear market is none of the problems that we saw in the past 2 bear markets are present today. Okay, so first I'd like to talk about the Asian financial crisis. So what was there during the Asian financial crisis? Essentially, we had an overheating Philippine economy. Okay, we really had problems in the Philippines, and there was significant asset inflation, meaning, for example, property prices were going up significantly in 1997, and even the stock market was very strong then. And the major problem was this was being funded by a lot of debts. And not only that, the debts were denominated in US dollars. So obviously, when the peso weakened, we saw a lot of defaults. Okay? So that was the problem in the Asian financial crisis. Now, the second crisis, which is more recent, the global financial crisis, the Philippines did not have a problem, but of course, the US had a problem, and we were negatively affected because of contagion again. In developed markets, particularly starting with the US, there was overheating taking place. Property prices were going up, and this time around, developed economies were the ones that were overborrowed, and of course, they were the ones borrowing overseas. Okay, so when the subprime crisis, or let's say property prices in the US fell, because there was so much global debt, a lot of the high net worth individuals and financial institutions, even outside of the US, were negatively affected to the point that even the Philippines was hurt by what happened. So contagion became really widespread. Okay. So this time around, we're not seeing any symptoms of the Asian financial crisis. We're not seeing any overheating. First indicator that we looked at is inflation rate. As you can see, inflation rate in the Philippines is only 0.8%. And then core inflation, if we take out oil prices, which actually fell quite a bit, it's still only 1.8%. I mean, if you look at the 97, 98 levels, 99, it was much higher. We're nowhere near that level at this point in time. And then our next slide, this is a slide of the property values in the Philippines, land values actually. The red dots would represent Makati CBD, which is, of course, the central business district. And then the blue dots would represent the Fort Bonifacio area, and the yellow dots would represent the Ortigas CBD. So those are the three major central business districts in Manila. And one of the things that you'd notice is, for example, in Makati, the 1997 level versus the level today. Okay, after so many years, prices in Makati are only slightly higher than what they were in 1997, although they have been going up since 2003. And for Ortigas, it's actually not yet even back to 97 levels. Of course, the BGC level is much higher, but you have to also admit that there are a lot of developments there, which justifies the increase in value. So if we really are overheating, we should see values, land values, significantly higher than what they were in 97. But we are not seeing that right now today. And are the banks overlending? Definitely not. One of the things we looked at is debt to GDP level. Philippines' debt to GDP is still quite healthy at 40.5%. Thailand, it's close to 100. Okay, we're more in line with Indonesia, which is still low. And then the next indicator is the loans to deposit ratio. This just means like what percentage of the money that you've deposited in the banks are being lent out to corporates and consumers. And at present, it's only at 65%. So I remember in 97, I was just starting out in my career as an analyst. And I was a banking analyst at that point in time. And it was very common to hear the banks talk about the loans to deposit ratio of 120%. And that is the reason why in the 1990s, if you made a deposit in the bank, they were willing to give you an interest rate of 10%. Because of course, they were lending out money in at a much higher lending rate. Right now, the banks will only be giving you a deposit rate of 1%. This is because they are not able to lend out your money. So in some ways, they are, there's no incentive for them to pay high deposit rates. And as far as the listed companies are concerned, we looked at the net debt to equity ratio, which is an indicator of financial leverage of corporates. It's just at 0.28 times, which is very low. Okay. Okay, and then earlier on, we talked about how in the past, people were borrowing in US dollars. And one way by which you can measure the level of borrowings in foreign currency is the current account position. Okay, the current account position just measures the amount of dollars that come in less the amount of dollars that go out. For example, if you have more imports than exports, this would become negative. So you would notice in 1997, we had the negative current account position. So we had the current account deficit in 97. But you will notice that since 2003, we have had a positive current account surplus, current account position. And today it's at 5%. This just means that right now we are a net dollar earner. We have more dollars. We have not been borrowing foreign debts. Okay, this is because OFW remittances have been growing quite significantly. So for the first 6 months of the year, it's up by 5.6%. BPO revenues have also been very strong, and the IBPAP is actually projecting it to hit 25 billion US dollars to exceed the value of OFW remittances. Okay, and we also looked at listed companies just to check whether or not they've learned their lesson in the Asian financial crisis, or is there this temptation for them to start borrowing again in US dollars. And fortunately enough, our listed companies are still not borrowing in US dollars. Okay, so what about China? Is there a risk that China will be like the US in '07? We don't think so. China definitely has problems because obviously you see, debt levels have been going up with debt to GDP at 282%. Okay, that is quite a high level. But at the same time, the economy has been slowing down, as you can see on the GDP growth. So because of that, obviously there's a risk that banking loans would default. Okay. But what we'd like to point out is that unlike the US in 2007, China actually has a very strong balance sheet. The Chinese central government has a strong balance sheet, meaning they can absorb any potential losses from loan defaults. You can see China's debt, or sorry, yeah, debt to GDP. Central government debt to GDP is only at 41%. 41%, although this is higher than what it was before, 41% is considered to be very healthy. The Philippines debt to GDP is 45%. Developed economies, or the average of developed economies, is actually 101%. So a 41% debt to GDP ratio is very healthy, meaning that China can absorb potential losses. Okay. And then, more importantly, China's debts are not externally funded, meaning, there's very minimal risk that you have Filipino banks or, say, American banks lending to China being affected by defaults to the point that credit markets will freeze, similar to what happened in '07. So China's current account position is also in a surplus. They are a net lender to the world. They're one of the biggest holders of US treasuries. So in that respect, there's very little concern that their problems will spill over to the rest of the world. Okay, so the Philippines, we believe that our long-term fundamentals are good. So we believe that after this correction is through, our market will still continue to go up. So earlier on, we talked about one of the major problems of the Philippines. And it was a slower than expected GDP growth. Okay, so one of the reasons why we had a slower than expected GDP growth was because the government did not spend enough. But I just like to point out that the government did not spend enough, not because they didn't have money. Our government has the money. As you can see, the budget deficit to GDP is, not alarmingly high. Deficit to GDP is negative 1.1%. Okay, so it's still quite healthy, and the debt to GDP level is on a downtrend and is at 45%. So very healthy. So it's not a problem of not having money, it's a problem of not being able to deploy that money, which for me is actually an easier problem to solve. Okay. And then one of our saving graces is our consumers. And, if you show this infographic to foreign investors, I mean, this summarizes why foreign investors are very excited to invest in the Philippines. They are investing in the Filipino people. Okay? So why are we excited about consumer spending in the Philippines? Okay, first you have a growing population. Our population still growing by 1.8%. Okay, and then the average or the median age is 23.3 years old. So I mean, if you think about it, if you are in business, you still have a market that is growing and a market that is slowly becoming more capable of buying higher valued goods. Because remember, at 23.3 years old, the person is just starting his career. So he still has the capacity to earn much more going forward. And 2015 to 2055 is the demographic window, okay, for the Philippines. The definition of demographic window is a period of high growth in a country as the productive population accounts for a bigger share of the population. Okay? So from 2015 to 2055, we will see a 48% increase in the size of the working population in the Philippines. And other countries that went through the demographic window enjoyed the GDP growth of 7.3% per annum, okay, which is really um, quite attractive and quite fast. And then finally, of course, our OFWs have been very resilient, sending money, um, no matter what. It's now at 24 billion US dollars. And of course, the BPO revenues are growing even faster and catching up, expected to hit 25 billion US dollars in a year or two. And then a lot of people are concerned about the elections next year, but I'd like to point out that no matter what, our consumers continue to spend. It doesn't matter who the president is. So we're not so worried about consumer spending going away, no matter what happens in the elections. And then one of the things that we also have that a lot of economies right now don't have is the growth in investment spending in the country. You will notice that investments to GDP, which is the red line, is clearly on an uptrend at 21.9%. And in fact, 21.9% is still low because in other countries, the ratio of investments to GDP is closer to 30%. Okay? So next. And one of the reasons why I'm quite confident that we can maintain a 21.9% level of investments to GDP is because our manufacturers are operating close to full capacity. Obviously, if you're operating at full capacity and if demand is picking up, there is much reason for you to actually increase your spending on investments or capital expenditures. Okay, and then our PPPs, after a very slow start, okay, the past 5 years, only 6.3 billion US dollars worth of PPPs have been launched and awarded. But right now we have 12.1 billion US dollars worth of PPPs that are in the bidding stage. Okay, so very soon these will also be started and completed, and as they become complete, of course, they will generate jobs and increase the productivity of the economy. And then, okay, what about China? Definitely we will be affected by China, but the way we see it, I don't think we'll be affected in a big way. Just comparing ourselves with our neighbors in Thailand, Indonesia, we are not as dependent on exports. So the green bar is Thailand, the red bar is Indonesia, we are the yellow bar. Okay? Admittedly, our exports as a percentage of GDP is at par with Indonesia, but the major difference is Indonesia is more dependent on the exports of mining products and petroleum products. So one of the major consequences of a weaker China is falling commodity prices, falling oil price. Indonesia is being hurt by that, whereas we are not very much being hurt by that because of our dependency on those types of exports. Okay, so what about major corrections? If we are suffering from a major correction, how long and how deep could it be? Okay, so based on the analysis of the past 3 major corrections, you can see that it seems that we have most likely seen the low of this correction. Well, in 2011, for instance, the market corrected because of the European debt crisis, the US debt ceiling, and we also had rising inflation in the Philippines. Okay, at the time, the first time it happened, which was early during the year, we corrected by 15.5%. And it took 4 months for the market to hit top to bottom. Okay? The second time in 2011 that we suffered from a major correction, the market fell by 18.6%, and it took 2 months to hit the top to the bottom. Okay? 2013, remember, we had the taper tantrum. The market corrected by 25%, and it took 4 months for the market to hit top to bottom. Okay? So this time around, we've already corrected by 18.8% from the market peak in April to to the 6,600 level last month. And so far, the correction has been going on for more than 5 months already. So I mean, in light of the previous corrections, there seems to be a strong likelihood that if history repeats itself, we have already seen the low. And 6.6 is also fundamentally a good level to, for the market to bottom. Because at that level, we would be trading at 16 times PE, which is the average PE of the market during the past 10 years. Okay. Okay, admittedly, although maybe we have seen the low, we think that the markets will not recover right away. We are not expecting a V-shaped recovery. We'll have the next few months, we most likely will see the market staying volatile where it is at right now. Okay, and why is that? Well, first of all, as discussed earlier on, corporate earnings have not been very good, like as far as our own projections are concerned. When we started the year, we were very excited because we were projecting earnings growth to hit 15% for this year. However, after the corporates came out with their earnings result for the first quarter, second quarter, and then after they made announcements about their earnings guidance, we have cut our earnings forecast from 15% to 4%. So in light of that, it's hard to make people excited, okay, at least in the short term. And then, of course, contagion from Thailand and Indonesia will most likely stay there. As discussed earlier, they will be among the major losers of a weaker Chinese economy, a weaker yuan. And aside from that, Indonesia is suffering from high inflation rate. And although they were expecting the government to increase spending, it is not yet materializing. Thailand, on the other hand, is suffering from overcapacity. So they can't, make investment spending pick up. Okay? And consumers in Thailand are not spending because they're all suffering from high debt levels. As I've shown you earlier, the debt to GDP of Thailand is at 97%. So, they have bigger problems than the Philippines. Okay, and of course, everybody's expecting the Fed to raise interest rates anytime soon, either this September or they said if it doesn't push through this September, it could take place in December. Of course, there are always concerns that we could see a repeat of the 2013 taper tantrums. Okay, next. Okay, in light of all of that, we are recommending investors, though, to start accumulating, but use a peso cost averaging method rather than investing it all at once using the lump sum method. Okay? So while the stock market could remain weak and volatile in the short term, investors should take advantage of the current situation to start accumulating stocks. Okay? As at cheaper levels, this is because the long-term outlook of the market remains attractive. Okay? So buy on a staggered basis using a peso cost averaging strategy. Okay, and we believe that this will allow you to manage volatility. And in case the market does go down a bit more, at least you can buy at cheaper levels. We recommend that you do this for the next 6 months. Okay. So another thing we are recommending right now is focus on quality issues. During conditions such as these, when markets turn, typically it will be the more actively traded blue chip stocks that will lead the market higher. So in that respect, maybe it's better for you to focus on quality stocks. Now we're quite excited because in the past it was so difficult. When markets go down, people want to invest. It's so difficult to do stock picking. But right now we could actually do it with funds. Later on, Marvin will talk more about the funds that will be available through the COL platform. And by buying funds, actually, it's going to be an affordable way for everybody to diversify and buy blue chip stocks. Okay? So the major risk we see right now is, what if we're wrong? Okay? But one thing I'd like to point out to you is that what we're seeing today is a contagion-driven bear market. And as you can see here, the first one, which is the Asian financial crisis. The Asian financial crisis was a bear market wherein the Philippines really had problems. And noticeably, you will see that the duration of the bear market or the Asian financial crisis is much longer compared to the duration of the global financial crisis, which is a contagion-driven bear market. Okay? So just a comparison, during the Asian financial crisis, the drop of the market was much cheaper at 71%. And the bear market lasted for almost 5 years. That's a very long time. But the contagion-driven bear market only lasted for 12 months. Okay, and of course the depth, 56%, it's quite a bit, but it's shallower than the Asian financial crisis. Okay, so in summary, the Philippines is suffering from a major correction due to several factors, both in the Philippines and globally. Nevertheless, we remain confident that the Philippines will eventually bounce back and stay in a bull market over the long term, as none of the characteristics of past bear markets are present today. Okay, there's also a strong likelihood that we have already seen the low of this correction based on the magnitude and duration of major corrections in the past. Okay, since we expect volatility to continue and for the markets to take a while to recover, we recommend investors to accumulate stocks using the peso cost averaging strategy and focus on larger capitalized, actively traded stocks trading at attractive valuations, as these stocks are expected to lead the market's eventual recovery. Okay, just a few quotes before I end my presentation. So this quote came from Peter Lynch. So he's one of the best fund managers in history, generating a compounded annual return of 29% for his fund. Okay, and he wrote the book One Up on Wall Street, which is actually one of the best books that I've read about investing in the stock market. Okay, so he said that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. Okay, so don't be too worried about corrections. Okay, next slide. So he also said that I've found that when the market's going down and you buy funds wisely, at some point in the future, you will be happy. You won't get there by reading, now is the time to buy. Okay, so with that, I'd like to encourage everyone to stay invested. I'll just make a short plug about COL. Happy to announce that we are in social media. We're now at Facebook, YouTube, and Twitter. I also have my own Twitter account. We tweet about our research materials there. So please follow us in all these social media channels. Thank you very much.
Thank you, Ms. April Tan, for that market outlook. I think we've heard some good news today. Do you agree? Yes, and that being said, we can therefore maximize our cash by investing in funds.